Have you ever felt lost hearing terms like diversification, asset allocation, or portfolio strategy? You're not alone. But the truth is, building a strong investment portfolio doesn't require a finance degree. It just needs the right mindset and the right roadmap. Today, we'll build that roadmap from scratch. Let's go. Imagine your financial future like a house. Your investment portfolio, that's the foundation. An investment portfolio is simply a collection of financial assets, things like stocks, bonds, real estate, and cash, that work together to grow your wealth over time. It's not about getting rich quick. It's about planting seeds and letting them grow. When you put money into different types of investments, you're essentially spreading your bets, giving your money more than one way to grow. Your portfolio is your personalized strategy for financial security, and how you build it depends entirely on your goals, risk tolerance, and time horizon. Here's a common phrase: don't put all your eggs in one basket. But when it comes to investing, it's deeper than that. Diversification means investing in different types of assets that don't move the same way at the same time. Why does that matter? Because markets are unpredictable. If all your money is in just one stock or one industry, a single downturn could wipe out years of savings. But if your money is spread across different sectors, asset classes, and regions, losses in one area may be offset by gains in another.
For example, when stocks go down, bonds might go up. When tech takes a hit, healthcare might rise. Diversification helps reduce risk without necessarily reducing your potential returns. It's not a magic trick, but it's the closest thing to one in long-term investing. Now let's break down the building blocks of your portfolio. They're called asset classes, and here are the main ones. Equities, stocks, ownership in a company. Over time, they can offer high returns, but they come with higher risk. Volatile, yes, but essential for long-term growth. Bonds, basically loans you give to companies or governments in exchange for interest. Lower risk than stocks, but also lower returns. Cash and cash equivalents. Think savings accounts or money market funds. Safe, but barely grow your wealth. Best for short-term needs or emergencies. Real estate. Physical property, or REITs, real estate investment trusts. Offers income and long-term appreciation, but can be illiquid. Commodities. Gold, silver, oil, etc. These tend to behave differently from stocks and bonds, useful during inflation or market downturns. Each of these has a different risk-reward profile. A well-diversified portfolio often includes a mix, not just one or two. The exact percentage? That depends on one thing. Before you build your portfolio, you need to know one thing. How much risk can you handle, and how much do you need to take? Ask yourself, how would I react if my investments dropped 20% in value? When do I need this money? 2 years from now? 20? Am I investing for retirement, buying a house, or wealth preservation? If you're younger and have time on your side, you can afford to take more risk for higher long-term returns. That might mean more stocks. If you're close to retirement or can't stomach big losses, you might lean toward bonds or cash-based instruments. Here's a general rule of thumb. The longer your time horizon, the more risk you can take. The shorter the horizon, the more protection you need. Your risk tolerance isn't static either. It changes with your life circumstances. Check in with it often. It's the compass of your portfolio. Let's bring it all together. Let's say you're just getting started. You have $1,000 to invest. How should you split it? A conservative portfolio might look like this: 20% stocks, 60% bonds, 20% cash or money market. A balanced portfolio could be 50% stocks, 40% bonds, 10% cash. An aggressive portfolio might be 80% stocks, 15% bonds, 5% cash. These aren't rigid rules. They're starting points. And remember, it's not just what you invest in, but how consistently you invest. Use dollar cost averaging. Invest a fixed amount at regular intervals. This smooths out volatility and builds discipline.
Also, start with broad market ETFs or index funds. They offer exposure to hundreds of companies at once, making instant diversification easier and low cost. Keep your costs low, stay patient, and let compounding do its thing. Now that you understand asset classes, let's take diversification a step further. It's not just what you invest in, but also where and which industries you invest in. Let's talk geographic diversification first. Imagine you invest only in tech stocks from one country. If that market faces a downturn or political instability, your entire portfolio suffers. But when you invest globally, a slump in one region may be balanced by growth in another. Emerging markets may offer high growth potential, while developed markets bring more stability. Investing across continents spreads both opportunity and risk. Then there's sector diversification. Industries behave differently depending on economic conditions. Technology might boom during innovation waves, but consumer staples like food and hygiene tend to remain steady, even in downturns. Here's an example. Let's say you hold 25% in tech, 20% in healthcare, 15% in energy, 10% in real estate, 30% in broad market index funds. You've diversified not just by asset class, but by industry and geography. It's a layered defense system for your portfolio. Let's say you started with 60% stocks and 40% bonds. A year later, the stock market rallies. Now, stocks make up 75% of your portfolio. Sounds like a win, right? Yes and no, because now you're exposed to more risk than you initially planned. That's where rebalancing comes in. Rebalancing means adjusting your portfolio back to your intended allocation. It's like taking profits from the overgrown parts and redistributing them. You can rebalance in several ways. Time-based, once or twice a year. Threshold-based, when an asset drifts more than 5 to 10% from its target. Event-based, after major market movements or personal milestones. Rebalancing does two things. It maintains your preferred risk level. It enforces a buy low, sell high discipline without emotional decision-making. Think of it as portfolio hygiene, just like brushing your teeth. Not glamorous, but essential. Let's be honest, fees eat your returns. And over time, even a 1% annual fee can make a huge dent in your portfolio growth. Here's how to keep your costs low and still get broad exposure. Informative index funds. These track a market index like the S&P 500. No active manager equals lower costs. They're efficient, transparent, and historically reliable. Informative ETFs, exchange-traded funds. Similar to index funds, but trade like stocks. They offer flexibility and access to sectors, commodities, or global markets, all with low fees. Informative robo-advisors. Automated platforms that build and manage diversified portfolios based on your risk tolerance. Some are low cost and ideal for beginners. Positive. Brokerage platforms with zero commission trades. Many online platforms now offer commission-free trading on stocks and ETFs. That's money saved. Always read the expense ratio before investing in any fund. Even a difference of 0.25% versus 1% can add up to tens of thousands of dollars over time. Let's address the traps investors fall into, because knowing what not to do is as important as knowing what to do. Warning: chasing past returns. Just because a stock or fund did well last year doesn't mean it will again. Past performance is not a guarantee of future results. Always focus on fundamentals and your long-term plan. Timing the market. Trying to predict when to buy low and sell high sounds smart, but almost no one gets it right consistently. Time in the market beats timing the market. Lack of diversification. Putting all your money into one asset, like crypto or a hot stock, can feel exciting, but it's gambling, not investing. Emotional investing. Panic selling during a dip or FOMO buying during a rally will derail your plan. Your portfolio is built on strategy, not feelings. Ignoring fees. Hidden costs can quietly erode your gains. Always know what you're paying and what you're getting in return. Remember, investing isn't about being perfect. It's about being consistent and learning from mistakes without repeating them. If there's one thing that separates successful investors from everyone else, it's patience. Let's look at the math. If you invest $500 every month into a portfolio that earns an average of 7% annually, in 30 years, you'll have over $600,000. That's not magic. That's compound interest, working quietly in the background. But here's the catch. You only get those results if you stay invested, even when the market dips. Markets go through cycles: bull markets, bear markets, corrections, recoveries. But over decades, they've always trended upward. The people who win, they don't panic during dips. They don't obsess over daily charts. They stick to their plan and trust the process.